we're going to a different economy, and we're going to be learning more about that as we go. But clearly, we're learning that things can be done from remote locations. We're learning that technology can replace people even more than we thought.
We're not going back to the same economy. We're recovering, but to a different economy, and it'll be one that is more leveraged to technology. And I worry that that is going to make it even more difficult than it was for many workers.
In Silicon Valley, and my friends who work in technology know that what we did to the manufacturing workers, we are now going to do to the retail workers, the call center workers, the fast food workers, the truck drivers, and then even bookkeepers, accountants, insurance agents, lawyers, and on through the economy. So what happened to the manufacturing workers is a very clear sign of what's going to happen to these other.
The digital asset that you don't see sort of being transactional on an everyday basis.
I don't see Bitcoin being transactional. I see it being a digital store of wealth, right? A digital asset. I think there are other cryptos that will fight and win in the payment system, right? Bitcoin is going to come out with Diem, which is a US dollar-backed stable coin, and they're going to try to dominate payments, right? There's USDC. There's all these coins that look and feel just like dollars because they're basically dollars wrapped in tokens that are going to come and participate in that. What's unique and why that's positive for Bitcoin is it's the same wallet, right? We're going to move from a world where your money's held in a bank account to where it's held on a wallet on your phone, and not just your Bitcoin, your stock certificates will be there. Your tickets to concerts will be there, and your money will be there that you used to transact in, and you'll be able to flip, seamlessly between.
After the Great Recession and the pandemic recession that we're just getting out of now, Fed balance sheet is vastly different, much larger than it was, say, 15 years ago. Now, I know this is not the time to shrink it. You're not. But look at past this current crisis and look ahead where we might be 15 years from now. Do you envision the Fed going back to a smaller balance sheet, having a more modest role in financial markets as it did in the past? Or do you think we're in a new world where this expanded balance sheet is a permanent fixture of the financial system?
I do want to begin by agreeing with your first point, which is the economy is far away from maximum employment and stable prices, and the balance sheet will be the size that it needs to be to provide support to the economy. And as you know, we're currently buying assets, and it's a key part of what we're doing in providing overall accommodation to the economy. That is our focus. We're not thinking about shrinking the balance sheet. Just to be clear, I just want to make sure that that's out there. But to get to your real question, in the long run, our balance sheet will be no larger than it needs to be to meet the demand for our liabilities and allow us to implement monetary policy effectively and efficiently. So it really is, in the long run, it's demand for our liabilities, which are the two biggest of which are currency and reserves. So when we buy assets, we're really thinking about buying assets. But when the pool of assets declines over many years, as it did after the global financial crisis, it really is the public's demand for our liabilities. So we will return to a place gradually with tons of transparency and not beginning anytime soon to a place where really the size of our balance sheet is set by the public's demand for our liabilities. It won't be the $20 billion balance sheet that we had in 2005. It won't, and that partly is just that growth of demand for currency has been surprisingly high at a time when in many other parts of the world, people are declining to use currency. Demand for reserves, though, reserves are the most liquid asset, and they're in high demand for banks to meet their liquidity requirements and payment utilities and all that. So the longer run, though, so we will get back to that, and we did ultimately do that after the global financial crisis. We froze the size of the balance sheet in 2014, and then as the economy grows, the balance sheet shrinks as a percent of GDP. In addition, reserves decline as currency and other liabilities sort of organically grow. So, but again, these are longer term. So the answer to your question is yes, with a long explanation.
Over the past so, the Fed and the Treasury have worked very closely together to support the economy, largely productively, I think. And now we have a Treasury Secretary that's a former Fed chair, which is an unusual circumstance. So I was wondering how you think about that. Do you think this is going to mean we're going to have continued collaboration, higher collaboration between the Fed and Treasury than we've had maybe historically? Is there any risk that that collaboration could threaten Fed independence? Or maybe the fact that there was a former Fed chair as Treasury Secretary will bolster Fed independence, because I'm sure Janet's a big believer in it, and maybe she'll help protect the Fed if there's any political pressure. So I was wondering how you sort of think about the Fed-Treasury relationship in this current environment.
Welcome to the Crypto Teacher. And guys, I come back with that video just to make you think. Now, we had Jerome Powell speak today. And as he said, they're not going to let up on this balance sheet, guys. $7 trillion and counting. 0% interest rates. And we see the actual Fed manipulating the yield. But guys, we know why all this is happening. We're going to be moved over to the fourth industrial revolution, Society 5.0. What does the Fed have in its back pocket that's going to get rid of inflation? That's right, cryptos. Cryptos are going to make everything cheap. Everybody's going to be getting free money. But we know there's no such thing as free money. We know there's a cost because this money is going to be programmable. They're going to know anywhere you go, what you're buying, how you did it, no privacy whatsoever. So whether you're in a village or in a city, it's a level playing field, guys. Now, we had Mike Novogratz state that Bitcoin is not going to be used for payments. Is that correct, guys? No, it is not. That was the whole point of Bitcoin. This store of value was an engineering of Michael Saylor and Grayscale. That's where it came from. So, guys, we know the central banks haven't got rid of their gold, so you'll be a fool to get rid of yours. We know China got reclassified as original Africans to take advantage of the emerging market and the gold. We know Bitcoin Lightning and Facebook Diem is working in the background. And USDC. We know those are going to be our main platform for payments. And I went over with Facebook. Facebook is the perfect platform because it makes everything social. And then plus they can connect the virtual reality in there. So now you can sit with your friends and shop in real time with each other instead of going to the mall. You can sit and do it right in front of your phone, computer, like if you were out shopping. Now, this digital gold narrative only works if they actually peg it to gold. Gold's total is about 10 trillion. Bitcoin has a long ways to go. But yes, that narrative definitely works if they actually peg it. But we have China in charge of Bitcoin mining. And guys, at first that was a big deal. It moved behind the curtain. That's all they ever talked about is why would we be putting our money into something that China is control of? That whole narrative went totally away. But we know China the dragon is going to rise. And Babylon the America is going to fall. And guys, do not forget, when it comes to the New World Order, everything is planned out. Y'all have a wonderful day.